I want to start here with this slide showing the 80,000 net new jobs created in the month of June. And this, of course, was described as a very disappointing jobs report, also a little bit less than the estimate of 100,000 net new jobs. But a couple of key takeaways from this chart. First of all, note the pattern here. It's not uncommon to have lots of volatility month to month in net new job formation, and whether or not you're coming off of recession into recovery. The fact is that month-to-month jobs data can be very volatile. And also note that in both of the last summers, we've seen similar in net new job formation. So 80,000 in and of itself is not a reason to believe that new job formation is collapsing, nor is it a reason to think that we're either in recession or necessarily that recession is just around the corner. The second slide here shows the two monthly job surveys that the Bureau of Labor Statistics does. The first is the 80,000 that I just referred to, the so-called establishment survey, but also released this morning was 128,000 net new jobs created on the so-called household survey. That survey is taken in a completely different manner, but here's the key takeaway. Over the last 6 months, we've actually seen 1.6 million net new jobs created on the household survey versus 900,000 on the establishment survey. So, whereas over time, these two do track one another quite closely. So we're getting a slightly more positive view of net new job formation on the household survey, most recently compared to the establishment survey. And that's a significant and material difference. I just wanted to point that out. Number three is an analysis, a breakdown of today's jobs report. And you can see here that if you look at net new private job formation, as a matter of fact, this series looks pretty typical, looks pretty normal. The red series is what I'm talking about. Net new private job formation of 84,000 in the month of June. Total was the 80,000, and again, a subtraction in the public sector. It's unlikely, at least in my opinion, that we're going to see a recovery or positive job formation in the public sector anytime soon, given the both federal, state, and local budget constraints. But I think the important point here is that the private sector has been looking very normal, at least in my view, with respect to new job formation. And this may be one of the reasons that the President said what he did last month. The private sector is doing just fine. And of course, there are a lot of ways to interpret that. But one of the bases on which he was saying that is, as a matter of fact, net new gains in private payrolls have been looking pretty typical coming out of recession. And again, here you saw last summer's slump and the summer before's slump in the private payrolls. And another data point here that I think is important, ADP released their June net new jobs created figure, and that was 176,000 versus 84 on the BLS, the number we just talked about, the private sector net new job formation, 84,000 on the BLS data versus 176 on ADP. So again, a more positive picture than we're getting from the government data from ADP. And actually, we've seen this positive divergence in the ADP data 2 months in a row. But also, you can see the last two summer slumps in net private job formation in this chart as well, suggesting that we may be in for a similar experience this summer. Time will tell, but I think there is good reason to believe that this too will turn out to be a summer slump as opposed to a significant inflection point downwards in net new job formation. And then finally, I just wanted to comment on the weekly unemployment claims data, because this is definitely not a picture of collapsing job formation. We've seen this collapse in unemployment claims from the recession peak of over 600,000, most recently under 400,000, and in the most recent 2 consecutive weeks we've seen downticks once again. So my interpretation of this data is that despite the recent backup, we have witnessed a summer backup in the context of this bigger picture of downward trending weekly unemployment claims. In other words, you'd have to see a pretty dramatic change in this picture to suggest that that we've seen a fundamental inflection point in the job formation picture based on weekly unemployment claims. The other negative piece of data that we got very recently, and it's another reason for my doing this mini webinar here today, is the ISM Manufacturing Purchasing Managers Index, and this was a big plunge, as you can see, and also a big negative surprise. So a couple of observations. First of all, note the historic volatility in this data series. The mere fact that you had a big downstroke in ISM manufacturing is not in itself a reason to believe that we're either in recession or headed for recession. Historically, manufacturing has been and will continue to be very volatile month to month, quarter to quarter. And you can see that even in the context of earlier expansions, you had big contractions in manufacturing. Remember, manufacturing as a percent of total employment in our economy, for example, is just 9%. And in output, it's something like 14%. So this is a very, actually, relatively small sliver of the economy. But at the margin, it's very volatile. So from quarter to quarter, it can have a material impact on total GDP calculation. But remember, it's a fairly small sector of the total economy, and it is also very volatile month to month, quarter to quarter. But the other observation that I just wanted to highlight, embedded in this ISM manufacturing PMI, was that the employment sub-index at 56.9 actually was very strong. And that ties to the comments I was making earlier on the employment picture. That was actually a positive divergence and suggests that employment remains strong, and even as month-to-month manufacturing ticked down pretty dramatically. Now, probably more important than the ISM manufacturing PMI is the non-manufacturing PMI, for the reason I just suggested. Non-manufacturing captures the vast majority of the U.S. economy. And here, at 52.1, we're still looking at an economy in real time. In other words, this is good coincident data, and it's the reason I spend any time at all talking about the ISM Purchasing Managers Index data, because if the question is, are we in recession, the answer is you have to look at the coincident economic data, the most recent run rate. And these PMIs are actually broad and deep measures of current economic activity. And so this one is suggesting that, well, with respect to the vast majority of the economy, we're still at a pretty good clip in the rate of expansion, 52.1. Yes, it's down from the most recent high here at well over 55, but that clearly was an aberration. That was not sustainable. And again, I conclude from this data that no, the economy has not slipped into recession. I personally believe it's not going to slip into recession. I'll get into that in a moment. And also the new orders sub-index. New orders are always something we want to take a careful look at, because they are the forward-looking component of any survey like this. And at 53.3, they were still strong. And then also, importantly, with respect to the jobs picture, this data, the employment sub-index, also at 52.3, was up from the May number, indicating a pickup in hiring. That was very encouraging data. So what about it? I don't think we're in recession, and that's because of what I just described, the most recent coincident data. Now let's try to assess the question of, are we headed for a recession? And here I think the best we can do is look at the index of leading economic indicators. So here's the most recent U.S. Index of Leading Economic Indicators, the so-called LEI, compiled by the Conference Board, and this is monthly data. The economic data in general reflect a U.S. economy that is growing modestly, neither losing nor gaining momentum. That's the conclusion from the Conference Board with their most recent release of this data. I think that's a very important data point. Now, if we analyze that data a little bit further and look at the 6 6-month rate of change. This is my favorite way to analyze change in trends in the forward-looking economic data. And what you see here historically is a very clear picture that the LEI, the 6-month rate of change of the LEI has substantially slipped below zero. In other words, the slope of this curve has substantially flattened and then rolled over well before the onset of recession. You see that? I hope you see that, because I think this is very important data. So you see here, for example, the 6-month rate of change slipped substantially negative prior to the onset of recession in each of the previous recessions we've seen in modern economic time period. And today we are nowhere near that. Further, to quote the Conference Board, they say, pointing to a relatively low risk of a downturn in the second half of 2012. Again, a very interesting observation from the Conference Board, I think. Now, the other weekly leading index compiled by the ECRI is what you see in this chart. Now, interestingly, this actually has ticked up for the most recent 2 consecutive weeks, and this is the trend you see. In my view, this is clearly not suggesting a fall into recession, at least as it currently stands, notwithstanding the fact that the ECRI themselves declared last September that a recession was imminent. It seems to me that that probably was a mistaken call, and unless and until this index rolls substantially further over, I would conclude from this, just based on the historic illustration here, that this thing has to substantially roll over for a more sustained period of time before you get too concerned that the economy is slipping into recession. So when you add it all up, what do the most economists believe with respect to the outlook? And that's what you see captured in this chart. This monthly compilation from the Wall Street Journal of the 50 economists that they survey with respect to the economic expansion forecast for the next 3 quarters is what you're looking at here. And yes, number one, it's important to note that in their June survey, they did cut their forecast for economic expansion, for the rate of economic expansion in each of the next 3 quarters, second, third, and fourth quarters, as you see here. The point is, I think the important takeaway is that most economists, as they analyze all of this data that I just showed you this morning, as well as lots of other data, what they're concluding is, no, the rate of expansion probably will continue to improve somewhat in the second, third, and fourth quarters of this year. Now, obviously, economists can be wrong, and important to note is that they have been seriously wrong at key inflection points in the U.S. economy historically. But on the other hand, you have to start somewhere in analyzing the economic data, and I think it's interesting to note that the best and brightest economists continue to believe that actually the rate of economic expansion will pick up, continue to pick up in the next 3 quarters, current quarter just completed, as well as the third and fourth quarters this year, based on everything that they're looking at. And then finally, the last slide I wanted to share with you this morning is the Federal Reserve's most recent forward look at the economy. And this is very current, very hot off the press from the Federal Reserve, from their Open Market Committee meeting notes from the meeting data as of June 20th. So that's that's only 2 weeks old. And so what the Fed said is also they cut their estimates of forward economic expansion from the dotted lines to the solid lines. But nonetheless, the Fed also continues to believe that we'll continue to see a bit of a pickup in the rate of economic expansion in the back half of this year into next year and ultimately into 2014. The economy reverts back to something that looks a lot more normal. Remember, the U.S. economy's rate of economic expansion post-World War II averages about a little over 3% per year. So going forward, what the Fed is saying that we'll continue to see a reversion to the mean rate of long-term economic growth in the U.S. economy over the next 2 years. Again, they could very definitely be wrong in this assessment, but as I said, you have to start somewhere in analyzing all of the economic data, and this is the best guesstimation from the Fed most recently.